Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. We're looking at a company today that has not only, defined the last decade of digital communication, but is very actively trying to define the next one. Today, we are breaking down one of the most powerful, I think it's fair to say one of the most controversial and definitely one of the most financially complex entities in the world, Meta platforms.
Formerly Facebook, of course.
Exactly, formerly Facebook. We're talking about a company that owns and operates four of the world's most used applications. You got Facebook, Instagram, Messenger, and WhatsApp. I mean, the sheer scale of it generates almost unimaginable cash flow.
It's a fire hose of cash.
It really is. And Meta has gone through this really intense period of self-correction. It's been driven by an almost painful efficiency effort and a strategic, multi-billion-dollar bet on AI infrastructure. So the central question for us as analysts focused on durable long-term value is this. Has the stock rebounded so strongly that it's now pricing in an assumption of, well, future perfection?
Right. Is all the good news already in the price?
That's it. We need to determine with, surgical precision if their core digital advertising fortress is truly impenetrable, or if that massive Reality Labs investment represents an existential drag on capital that the market is just sort of conveniently choosing to ignore right now.
That is the perfect way to frame it. It's a conflict, really, between two distinctly different entities operating under one ticker symbol. And before we try to, disentangle the core business from that multi-billion-dollar bet on the future, just a quick note for everyone watching and listening. It's about how we can turn these analytical insights into action.
Yeah, good point. For those of you who want to act on these investing ideas or even just manage your current portfolio with institutional-grade tools, having a professional platform is it's really non-negotiable. We consistently use Interactive Brokers. It's a platform known for its robust global capabilities, competitive pricing, and we've partnered with them. They offer our viewers a stock bonus when they sign up, which is just a fantastic way to get started or maybe upgrade your trading environment.
So it's a true win-win. You get access to a professional platform, and you support the channel's ability to conduct these really in-depth research dives. That link, which has all the details on the benefits, is right there in the description, just below the video.
That's right. And of course, if you find value in this kind of in-depth surgical discussion where we break down the competitive moats, the financial plumbing, the capital allocation track record, well, the best way to make sure you get the next one is to subscribe and click the like button.
It really does help.
It does. That feedback is vital for our continued research. And if you have any pressing, nuanced questions about Meta, maybe about the Reality Labs balance sheet impact, please drop those thoughts in the comment section below. We really do read them all.
Excellent. Okay, let's shift our attention back to the core analysis. We should begin with pillar number 1, the business model and the competitive fortress. We have to understand the bedrock that generates all that cash that funds everything else.
Right. Let's unpack the core model. It is, like I said before, deceptively simple, but globally dominant. Over 98% of Meta's entire revenue stream is generated through digital advertising.
98%.
It's all placed across what they call the family of apps, or the FOA. So Facebook, Instagram, Messenger, and WhatsApp.
And we need to focus on why that mechanism is so dominant. It's an auction-based system, of course, where advertisers are all bidding against each other for placement.
Standard stuff.
Right. But the real dominance, the secret sauce, it comes from the hyper-precision targeting that's now morphing into hyper-efficiency through AI. Historically, they knew demographics, interests, relationships, what you could call identity data.
Who you are.
Exactly. Now, their AI knows your intent, the timing, the likelihood of conversion, and it knows this across 4 separate globally scaled platforms.
Yeah.
That consolidated data set, it just delivers an unmatched ROI for marketers compared to any fragmented alternative out there.
And when we think about the endurance of this model, it's important to realize it's not built on some fleeting technology. It's built on fundamental human structural trends.
Yeah.
The first trend is simply the persistence of human connection. People need to communicate, they need to share, discover, and Meta provides the global infrastructure for this fundamental human drive. It's sticky because it solves a basic human need,
And the second trend is just pure financial physics. It's the efficiency of targeted advertising.
Yeah.
Businesses, they just cannot afford to guess where their customers are anymore. They have to find the most efficient and highest ROI way to reach them. And Meta's massive trove of identity data, combined with its new AI delivery systems, just offers an unmatched level of targeting efficiency. In a world where attention is so fragmented, Meta offers consolidated, predictable reach. That feature alone is becoming more, not less, valuable to marketers.
We do have to mention the secondary stream, but just for context, it's tiny. It's roughly 2% of revenue, and it comes from Reality Labs.
The Metaverse bet.
Exactly. The sale of AR/VR hardware like the MetaQuest headsets and the related software fees. It is growing, but when you're talking about a multi-hundred-billion-dollar revenue engine, it truly remains a rounding error. And that just underscores the absolute criticality of the core ad business.
Absolutely. Which brings us to the source of that juggernaut, the economic moat. If you survey the investing world, the consensus is pretty clear. The moat is network effects, and, rightly so. It is the primary moat, the virtuous cycle.
What's fascinating about Meta's network effect is the sheer exponential utility of it. This isn't just about utility, it's about social obligation. It's about connectivity lock-in. Take WhatsApp. Its utility to you as an individual user, it increases exponentially with each contact who adopts it.
Right. If my friends aren't on it, it's useless.
Exactly. This critical mass forces adoption in key global regions like India or Brazil, making it the default messaging platform. That dependency creates these immense switching costs. You literally can't leave WhatsApp in some places without losing your most important social connections.
And that self-reinforcing loop is the fortress wall. Advertisers flock to Instagram because the user base is massive and highly engaged.
Which brings in more money.
Right. That ad revenue funds the infrastructure, the AI, the data centers, which improves the product, which then attracts more users, reinforcing the entire loop. This makes it prohibitively difficult for any competitor to achieve meaningful scale in both users and advertisers at the same time. You need both sides of that marketplace to succeed, and Meta basically has a monopoly on both.
But that moat was tested. It was tested profoundly, most recently by TikTok and the whole short-form video craze.
A huge test.
They started eroding youth attention and discovery time. But Meta responded with Reels, integrated the format across both Facebook and Instagram. This aggressive adaptation is crucial. They didn't just survive the challenge, they proved they could quickly copy, integrate, and scale a new entertainment format by leveraging their existing vast network of social graphs.
And this is where we need to introduce a really key nuance about all the capital spending.
The CapEx.
That massive capital expenditure everyone talks about, the AI infrastructure spending, it is fundamentally strengthening the core business moat. It's not just funding the metaverse. Better AI means better content ranking, which means higher user engagement. Higher engagement translates directly to more ad inventory. And better AI for ad delivery drastically increases advertiser ROI.
So the spending is actually widening the moat.
Exactly. The AI spending is widening the competitive advantage against rivals who simply lack the capital scale and the data to make those kinds of investments.
If we use Charlie Munger's framework here, Meta's core business is the textbook toll bridge. It's this mandatory stop over which a huge portion of global communication and digital advertising has to flow.
It's a utility for connection.
It is, but with fantastic software margins.
And that toll bridge is protected by what Munger called the Lollapalooza effects. It's not just one advantage, it's a confluence of these nonlinear forces. You have the network effects, creating that critical mass. You have high switching costs, keeping users locked in socially. And you have the intangible assets.
The brand names and the data.
Most critically, the proprietary user data set. When these forces combine, the resulting competitive advantage is far, far stronger and more durable than the sum of its parts. This is why trying to disrupt them with just a better product is so difficult.
So, okay, if that moat is so robust, why did the stock collapse in 2022? A toll bridge implies pricing power and stability, which Meta clearly lacked when Apple's privacy changes hit.
That's a critical challenge.
It forces us to analyze the direct, modern threats.
It does. And it brings us to the distinction between a structural moat and execution risk. The moat remains, but their execution was challenged by changes in the operating environment. Today, you have three primary combatants. First, Alphabet, specifically Google Search and YouTube. Their advertising dominance relies heavily on intent-based data.
What are you looking for right now?
Precisely, what you are actively searching for at that moment. This is fundamentally different from Meta's identity-based data, who you are, who you connect with, and what you generally like. They capture different complementary parts of the consumer journey.
Okay, then there's the second one, the attention king, ByteDance and TikTok. TikTok's core strategy is owning the attention economy through a hyper-efficient, interest-based recommendation algorithm for short-form video. Their distinction is having a weaker social graph.
Right. They don't really care who your friends are.
Exactly. They don't rely on existing relationships, which makes them easier to adopt but harder to monetize broadly across all demographics. Meta has that core social layer that TikTok completely lacks.
And the third major player is Amazon. Their strategy is e-commerce and retail media. They capture the consumer at the immediate point of purchase intent.
Right at the finish line.
Exactly. Their ad offering is highly valuable because it is so far downstream right before the transaction. They're capitalizing on Meta's ad exposure and driving it straight to a sale. But in terms of global scale and breadth of identity data for brand building and top-of-funnel marketing, they are still much smaller than Meta.
So this analysis really highlights Meta's unique, durable advantage. The sheer scale and breadth of its social graph across 4 global applications. No one else has this kind of visibility.
No one.
It gives them a unique, defensible, and incredibly rich data set of a user's true identity and relationships that is constantly being refreshed.
Just think about the data richness for a second. They know what you search for on Facebook and Instagram. They know who your closest friends are from Messenger and WhatsApp. And they know what groups you belong to. That richer, more complete picture of the user, combined with their new AI tools, allows for superior long-term targeting and re-engagement. The challenge is just converting that raw data advantage into efficient ad delivery, which is exactly what the AI investment is designed to solve in this post-Apple world.
But the fortress analysis isn't complete without the Scuttlebutt simulation, looking at the human element, the customers and the employees. And this is where the profound paradox of Meta really emerges.
Absolutely. The customer love versus company tolerance dynamic is striking. Users love the utility. They need WhatsApp to communicate internationally or Instagram for lifestyle discovery. They need the function, but they often actively dislike the Meta brand itself. They associate it with data privacy concerns, excessive ad load, content moderation issues. The consensus seems to be, I hate that I need this company, but I need its product to function socially or professionally.
And that necessity, which is built into the core social graph, is just so powerful and resilient.
And it is.
And then we have to analyze the employee sentiment shift. Historically, the culture was defined by this mission-driven work connecting the world, and it was famous for high perks, high autonomy engineering.
Oh.
That has been fundamentally replaced since the aggressive 2022 layoffs and the pivot to efficiency, which was really driven by the investment community's reaction to all the Reality Labs spending.
Yeah, we've seen anecdotal reports suggesting a much more cutthroat, pressurized environment now. It's heavily weighted towards measurable performance metrics and often criticized for a relentless pace. And while the compensation and the sheer scale of the engineering challenges remain a draw for top talent, this culture shift carries a significant medium-term risk.
I'll say it.
Well, if the workforce becomes burnt out, if they're focused solely on short-term efficiency targets, or if they're psychologically guarded due to layoff fears,
It could stifle innovation.
it could severely threaten long-term innovation and the quality of the core platforms. True, disruptive innovation requires psychological safety and the ability to test, fail, and iterate something. A hyper-pressured, fearful environment often kills.
So the cost savings are immediate, but the cost to the long-term R&D culture is invisible and delayed.
That's the tension right there. They achieved financial efficiency by necessity, but the long-term cost to their creative capital remains a huge open question. Now, let's pivot from the business model itself to the stewardship of that massive cash-generating machine. Let's talk Pillar 2, management stewardship and financial resilience.
This segment, it begins and ends with the founder, Mark Zuckerberg. His philosophy is explicitly long-term, product-centric, and founder-led. He is perhaps the purest example of an owner-operator in the entire S&P 500.
What defines his tenure is just a resolute willingness to resist short-term market pressures to make these bold, decade-long bets. The acquisition of Instagram was one. The pivot to Reality Labs is the most dramatic example we've ever seen.
And that owner-operator mindset is structurally reinforced, isn't it, by the super voting control structure?
Absolutely. His Class B shares give him effective control over the board and the strategic direction. It insulates him from the kind of activist shareholder dissent that might have forced a spin-off of Reality Labs years ago.
And we do have to acknowledge that his financial incentives are perfectly aligned with long-term shareholder value, even if his timeline is measured in decades.
Oh, completely. His personal wealth is overwhelmingly tied up in the stock, and his modest cash compensation relative to peers reinforces his commitment to product execution and long-term equity appreciation. He wins only if the shareholders win over over the extended horizon that he dictates.
Okay, so let's critically examine the capital allocation track record. It's highly mixed, I think we'd agree, but the recent trend is positive.
I would agree. On the successful side, we have the highly prescient, opportunistic M&A track record. Instagram, WhatsApp, Oculus, these acquisitions were immensely value accretive.
Trillion-dollar assets now, arguably.
Today, Instagram and WhatsApp alone are arguably multi-trillion-dollar assets in terms of the value they accrue to the Meta ecosystem.
But then there's the shadow hanging over this track record. Reality Labs.
The big one.
We have to be quantitative here. Reality Labs has been consistently posting operating losses exceeding $3 to $4 billion per quarter.
Every quarter, it's staggering.
Annually, that's a persistent $10 to $15 billion drag on profitability and free cash flow. This massive spending fails the traditional test of near-term return on invested capital, or ROIC. It's a high-risk bet with a deeply uncertain, decades-long return profile.
So, how does the spending pass the rationality test that investors demand? The acquisitions passed. Reality Labs, in a vacuum, does not. But the critical mitigating factor is the dramatic shift we saw in 2023. Management, responding directly to market pressure and sensing a historically low valuation in the core business, aggressively shifted focus to efficiency.
And they executed massive share repurchases.
Exactly. They deployed billions into buying back their own stock.
That action demonstrated a rational, shareholder-friendly behavior. It suggests they can and will course correct when the market sends an undeniable signal about misallocation of capital. They showed they could pull back on hiring, cut non-essential projects, and ruthlessly prioritize capital deployment to maximum shareholder benefit when the opportunity arose. That adaptability is key.
And let's talk about the bedrock that allows them to take these gambles in the first place. The financial fortress. This is where the company's quality ratios just shine, even under temporary pressure.
First, profitability and consistency. The core business generates exceptionally high and consistent operating and net income, tens of billions annually. The volatility we saw a couple of years ago was quickly overcome by the sheer velocity and profitability of the family of apps.
It's a fundamental structural advantage.
It is a high-growth, high-margin, low-churn digital utility business.
We have to drill down into return on invested capital, ROIC. Historically, before the Reality Labs ramp up, Meta's ROIC was exceptional. Often hitting 30 to 40%.
Which reflects the low capital intensity of software.
Exactly. You invest heavily once in code, and then you scale it globally at almost zero marginal cost.
But the heavy discretionary investment in AI and Reality Labs has temporarily pressured that ROIC ratio, hasn't it? It's dragged it down to the mid to high teens.
It has, but it remains significantly above the company's cost of capital. And that is the non-negotiable hallmark of a truly wonderful business. They are still generating economic value on their investments, even while absorbing a speculative, multi-billion-dollar loss center like Reality Labs. Very few companies can do that.
Okay, next is free cash flow, or FCF, conversion. The core ad business converts net income to cash flow with incredible efficiency. It's a cash machine by its very nature. But the overall FCF generation has been highly volatile because of the massive discretionary capital expenditures, that multi-billion-dollar spend on AI compute and data centers.
And the crucial recent trend is the reacceleration of FCF conversion, and that's due to the focus on cost discipline. By restraining spending in non-AI areas, more of that prodigious operating income is now flowing down to the balance sheet.
It's a direct result of the year of efficiency.
Yep. Prioritizing immediate cash generation over speculative long-term hiring.
And finally, the balance sheet strength is. The only phrase is extremely prudent. Meta operates with a consistent net cash position. Cash and liquid assets overwhelmingly exceed any long-term liabilities. They have virtually no meaningful net debt.
This fortress structure is the ultimate defense mechanism. It allows the company to withstand macroeconomic shocks, absorb massive investment losses like Reality Labs, fund long-term projects like AI without ever relying on external financing.
And execute huge opportunistic share buybacks when the stock gets cheap. They are financially impenetrable, which gives Zuckerberg the freedom to make the long-term bets he favors.
And that cash flow machine and fortress balance sheet dictate the third pillar of our analysis: valuation, risks, and catalysts. We need to figure out where the margin of safety truly lies in this unique business.
Meta's valuation profile is highly cyclical. It serves as a great lesson in market psychology. Historically, it traded at a growth premium, a high PE, high price to FCF.
Right, because of high growth and optionality.
Exactly. Then, in 2022, the stock just plummeted. It was trading at PE multiples in the low teens, implying a no-growth or even a decaying utility business, and that it rebounded aggressively as the core business proved resilient and management implemented those cost controls.
This volatility leads to a fundamental challenge. How do you define a margin of safety for a company like Meta today?
Right.
The safety buffer, we would argue, is not a low PE ratio because it's still a high-growth asset. Instead, it is found in the valuation of the core family of apps business alone, assuming zero or even negative value for the entire Reality Labs segment.
So an investor gets that critical safety buffer when the price they pay attributes little to no value to the massive, multi-billion-dollar Reality Labs optionality.
Precisely. And that scenario typically only arises during a market-wide panic where high-growth stocks are sold indiscriminately, or during a company-specific temporary setback like a short-term guidance miss driven by a sudden surge in AI CapEx, for instance.
Meta is the perfect case study for the principle that the price you pay is the ultimate determinant of your returns.
It really is.
Just consider late 2021. Investors were paying a premium multiple for the core business, implicitly pricing in perfection for the Reality Labs pivot, and the subsequent returns were abysmal.
Then you flip to late 2022. Investors were paying a historically low multiple for the highly profitable core business. They were getting that multi-billion-dollar RL bet essentially for free.
And the returns from that point have been astronomical. It just proves the value of buying a durable business when it is temporarily mispriced.
So now let's look ahead. What is the primary growth engine that will drive the next phase of earnings, pushing the stock beyond its current rebound levels?
I think it's singular and it's powerful. AI-driven ad relevance and performance across the core family of apps.
This is where that massive capital spending becomes value accretive. Their huge AI compute cluster is being used to overcome the structural challenges from Apple's privacy changes.
The ATT headwinds.
Exactly. Because Meta can no longer rely on granular third-party data tracking, they have to rely on broad AI inference to determine who to show an ad to. They are building these giant proprietary large language model, like Llama, to improve two things. First, content recommendation, which boosts user engagement. And second, ad targeting efficiency, which improves advertiser ROI.
And the mechanism is really elegant. Better content ranking leads to higher user engagement, which creates more ad impressions. At the same time, better AI targeting allows advertisers to pay higher prices because they see better returns.
So higher impressions multiplied by higher ad prices.
Equals a rise in average revenue per user, or ARPU. This AI virtuous cycle is the engine for the next 3 to 5 years.
But the optionality beyond that core engine is vast, and we have to spend some time on WhatsApp monetization. This is perhaps the most mispriced asset on their entire balance sheet.
You think so?
I do. It is a massive, untapped global network effect, particularly dominant in high-growth international markets like India and Brazil.
So why is it so vast? I mean, what's the path?
Because it's not just an advertising platform, it's a full-stack business and communication solution. Monetization is accelerating through two key channels. First, the WhatsApp Business API, where enterprise clients pay fees for customer service and notification delivery.
Okay.
Second, click-to-message ads. Advertisers on Facebook and Instagram pay premium prices to drive users directly into a WhatsApp chat. This generates extremely high-intent leads.
And crucially, this is evolving into a payment infrastructure opportunity.
Yeah. That's the holy grail. In markets like India and Brazil, they're rolling out payment functionality, WhatsApp Pay. If they can successfully integrate payments with business messaging, they unlock a massive financial platform opportunity that goes way beyond simple digital advertising. This is the single best path to unlocking a third major revenue stream beyond Facebook and Instagram, and I believe the market is still valuing it too conservatively.
And then there's the final piece, the AI-powered product cycle. This is the ultimate catalyst tied to Reality Labs. The long-term justification for the RL spend isn't just headsets, it's building the operating system and the user experiences for the next platform shift.
Whether that's augmented reality or next-generation AI interfaces.
Exactly. If they can successfully launch consumer-facing AI products and services like smart glasses powered by their AI models, or incredibly helpful personalized AI assistants, it could fundamentally boost engagement across the entire ecosystem.
And this wouldn't just provide new monetization pathways beyond simple display ads. It would defend them against the next platform shift by ensuring they own the interface layer, not just the application layer.
But all this growth and optionality, it's meaningless if the foundation is unstable. We have to analyze the permanent impairment risks, the low probability, high impact events that could permanently damage the investment thesis.
And the existential threat, the number one threat, remains regulatory risk. Specifically, a forced breakup or divestiture of Instagram and/or WhatsApp via antitrust action.
And that would be devastating.
It would permanently and severely damage the economic moat by shattering that Lollapalooza effect of having four interconnected social graphs.
And while the company recently achieved some significant victories against the U.S. Federal Trade Commission, which reduced the immediate legal risk of a breakup,
The political threat never goes away.
it doesn't. The ongoing political and populist threat never truly disappears. The sentiment that these platforms are too big or too powerful remains a persistent overhang. Headlines related to antitrust will likely accompany the stock for the foreseeable future.
The second major existential risk is a permanent audience shift. This is the risk of sustained, unrecoverable shifts in key demographic attention, especially among younger users, to a competitor.
A future, superior version of TikTok.
Or an entirely new, decentralized social layer, something Meta cannot successfully copy, acquire, or repel.
And if the core platforms lose that cultural relevance, if they just become the uncool place for youth to connect, the targeting data loses its value and the moat starts to decay from the inside out.
Meta has proven it can copy features like Reels. But if a competitor can create a fundamentally more aesthetically pleasing or culturally relevant product that captures the next generation, the network effect will eventually lose its primary source of replenishment.
This brings us to the final, and I think the most important phase of our deep dive, the investment memo synthesis. This is where we summarize the bull and bear cases and, crucially, run the red team challenge to invert our own assumptions.
Let's do it.
Okay, let's start with the bull case, the reasons to own Meta today. We have four major points. First, the impenetrable family of apps moat, protected by the world's strongest network effect. It guarantees stable and exceptional cash flow and high ROIC.
Second, the AI-driven reacceleration of growth. The aggressive AI investments are already paying dividends. They're driving ad relevance, user engagement, and higher ARPU, proving that capital spending can strengthen the core business.
Third, vast monetization optionality. WhatsApp is a multi-billion-dollar untapped asset, providing a third major growth engine that is essentially a free call option on future enterprise and payment revenues.
And fourth, the fortress balance sheet coupled with rational capital allocation, a net cash position, and a proven commitment to cost efficiency and large accretive share repurchases. It offers a fantastic financial safety net.
Now, on the flip side, the bear case. The counter thesis also has four strong arguments that demand respect. First, existential regulatory risk. That low probability, high impact threat of a forced breakup that could permanently destroy value.
Second, wasted Reality Labs capital. The continued, massive, and ultimately unrewarded investment in Reality Labs, serving as that long-term $10 to $15 billion annual drag on ROIC and free cash flow.
Third, algorithmic obsolescence. The possibility that the core platforms just lose their cultural relevance because they're fundamentally out-innovated by a competitor whose AI proves superior at capturing new generational attention.
And fourth, the CEO's dual-class control. Mark Zuckerberg's supervoting shares prevent external pressure. This means he can continue to fund capital-intensive projects like Reality Labs indefinitely, even if they prove value destructive if he believes they are necessary for his long-term vision.
It's a double-edged sword.
It is. It enables long-term thinking, but it also enables long-term hubris.
So this is where we run the red team challenge. We invert the bull case to find the most compelling contrarian argument that the market may be overlooking right now. And I think the most potent challenge is the infinite arms race thesis.
Explain that.
This thesis argues that Meta's attention-based moat isn't actually widening, it's shrinking, because user attention is infinitely fungible and susceptible to the next killer app. Therefore, the company is locked in an infinite arms race against the future, especially against ByteDance.
So under this cynical but compelling view, the massive AI and Reality Labs CapEx isn't an engine of future growth.
It's a treadmill tax.
It's a treadmill tax.
It is capital required simply to maintain the status quo against superior, culturally optimized competitors like TikTok. The high spending, in this context, is a sign of operational necessity and competitive desperation, not strength.
And if that treadmill tax hypothesis holds, the eventual outcome is that the core platforms slowly become less culturally dominant, ARPU growth stalls, and the enormous capital spent on the speculative Reality Labs bet fails to create a new platform.
And this converts a historically wonderful, high ROIC software business into a merely mediocre, high CapEx utility that is constantly spending billions just to stand still.
Wow. And the biggest risk in the current market consensus, which seems to view Meta as a fixed AI efficiency play, is that the market may be underestimating the risk of executive overconfidence.
Exactly. Once the core business is perceived as stabilized and the stock price is comfortable again, there's a distinct risk that management returns to reckless, capital-intensive spending that has historically punished shareholder returns.
That brings us to the end of our deep dive into Meta platforms. We have analyzed a story of profound tension.
On one hand, the undeniable strength of the core cash-generating advertising fortress, protected by a Lollapalooza effect of moats.
And on the other, the long-term, multi-billion-dollar bet on a non-consensus platform, Reality Labs. The current valuation depends entirely on which of those two businesses you think will define the company's next decade.
And that leaves us with our final provocative thought for you to consider. Does the market correctly value the CEO's dual-class control? Is Zuckerberg's willingness to make an enormous, multi-year, non-consensus bet on the metaverse the ultimate sign of long-term stewardship, a foundational strength that secures future platform dominance?
Or is it the ultimate risk of value-destructive hubris, protected only by that super-voting share structure, allowing him to pursue his vision at the expense of shareholder returns?
The answer to that fundamental question will ultimately determine Meta's trajectory and valuation for the next decade.
A huge thank you for joining us on Synaptic Investing for this surgical deep dive into Meta platforms. We appreciate you spending your time with us, and we look forward to hearing your thoughts in the comments.
We'll see you in the next one.